all this has to be paid back in a month at the interest rate and being renewed. This is not like you can lock in a low interest rate, let's say, because you're still paying 0% on the 10-year and 20-year treasuries that were issued 10 years ago. This is interest that you're paying now, which is why the interest expense is skyrocketing. Hey guys, Rafi here from the End Game Investor, and today we're going to go into the federal government going bankrupt. But I don't mean that as an abstract. We hear that all the time. The government's going bankrupt. But no. This time I want to show you the numbers, what's actually happening, what has happened in years past since 2008, and what is happening now. We've got a bunch of vertical lines going on because short-term interest rates are now at around 5%, and most of the government's immediate financing is on the front end of the yield curve, meaning from short-term bonds that they sell, and they have to pay that interest. And when they pay that interest, not only are they paying more interest, but they are getting less money from the bonds, because the higher the interest rate on the bonds, really the bills, they're called treasury bills on the front end, meaning from about 1 month maturity to 1 year maturities are called T-bills. And the higher interest rates go on those things, the less money they get from the auction. And from that, the interest expense on the national debt is now going vertical, and I'll show you that chart.
And at an average of 2.25% interest over a period of 1,000 years, that comes to $4.3 billion.
And while it is true that over the past decade and a half or so, interest on the national debt hasn't been much of an issue, that is because short-term interest rates and even long-term interest rates were really close to zero. So when you have to pay zero interest on your debt, it means that interest payments on your debt are going to be very low. Well, now that is reversing. And what does this have to do with gold and silver? We're going to read one paragraph from Daniel Oliver of Myrmikan, which explains mechanically why, when debt can no longer be serviced, that is when a currency collapses. All these things are coming together. They are coming to a head. And now that Powell has said he's going to raise interest rates even further, that is only going to increase the amount of interest to be paid in the national debt. And keep in mind the debt ceiling debate. There are many ways the dollar can die. This is just another one of them. And we've got something new at the channel. I've started an affiliation with MilesFranklin. And the reason I chose MilesFranklin is because I know the people involved in this circle. I know Andy. I know Chris Marcus. Andy Sheffman, obviously the CEO of MilesFranklin. I know Chris Marcus. I work well together with him. He also promotes MilesFranklin. I know Mario Monaco 64. He promotes MilesFranklin. These people in this edge or circle of the gold and silver community, they're all trustworthy guys. And these are the guys I want to work with, which is why I've also partnered with MilesFranklin. And of course, Dunnigan Kaiser of Liberty and Finance, Reluctant Preppers. All these guys are top-notch guys, and I'm proud to be in their circle of this community. So every week, MilesFranklin has a new special, usually in silver. This week, it's the RCM Silver Antelope coins. While supplies last, only $3.99 over spot. And since spot prices really plunged yesterday, today would be a good day for a good deal. You can help this channel, and you can help my cause and our cause by calling 855-GAME-END. That's 855-GAMEEND, and ask about this week's specials. And of course, this video is also sponsored by my patrons on Patreon, where I give a weekly biblical commentary on monetary policy and economic topics, and my subscribers at the Endgame Investor. Link in the description below for a 2-week free trial. So the first chart I want to show you here is the 6-month treasury yield. 6-month treasury rates are now above the 2006 high. This was the 2006 high over here where I'm circling. You can see here I moused over this part to inspect it, and the high July 10th, 2006 was 5.32%. That's exactly where we are now. We are at the 2006 high, and this was the previous rate hiking cycle. You know what happened after this high was reached? Yes, we had the 2008 financial crisis. Are we going to have a crisis here? Absolutely, we are. Exactly when we don't know, but we know, we've seen this before. We know what is going to happen next. Exactly how far it is out. It cannot be that far. Now, also, notice this flatness over here from 2009 to 2016. That is when a lot of the current debt was racked up in the post-2008, 2009 spending by government, and racking up the debt, really making it going vertical, but it didn't really affect the interest payments because interest rates were basically zero this entire time for about 7 years. And there was a time when interest rates started to go higher again, and this led to the repocalypse and the repo market broke down. It's not going to happen that way this time. It's going to be different this time. And then we go back to zero interest rates for another 2 years. And now, look at this, 5%. And now let's go through each of the interest rates of everything, all the securities on the T-bill end of the curve, meaning short-term treasuries. This is what we see. U.S. 1-month treasury rate, 4.71%. Let's go to the 2-month. 2-month treasuries, 4.805%. 3-month treasuries, 5% exactly on the dot. 4-month treasuries, this is a new security that's only a few months old. I think October 2022, it was introduced into the market as a way to, raise more debt. 5.123%. 6-month treasuries, 5.274%. And we go out to 1 year and we see 5.213%. So an average of all of these securities from 1 month to 1 year in the bills category is about 5%. Let's just call it 5% to keep the numbers simple. And from here, I wanted to move to this Zero Hedge article. See here, retail investors buy record amounts of 6-month bills in Monday's auction. Exactly how much is that? Accepted $46,046,426,000. $45 billion in 6-month bills. Why is it at a record? Because you get free yield for a 6-month bill. That's more yield than you would get in most stocks. So this is simultaneously sucking money out of the equity market and pushing it into the bond market, which should force rates down if money is being sucked to the bond market, but it's not, because the Fed is keeping its window, its effective federal funds rate, up to close to, I think, what is it now? 4.75, 4.5%, whatever it is, it's high.
Are you high? What? No, I'm not high.
You are high as a kite.
And it is causing this to happen. Next article, we see here from, look, it's like Ben Franklin is being IOU'd. Oh, that's really sad. This is from January 30th, 2023, so 2 months ago, about U.S. is spending record amounts servicing its national debt, interest rate hikes, and add billions to the cost. I just want to show you this chart here, and it's got a convenient little mouse over. If we zoom in, we can go closer. And we have U.S. interest payments rocketed as Fed hiked rates. Now, we see here what is going on in 2008, 2007. That's when they started lowering interest rates again. And here, even though interest rates are zero, the amount of interest being paid per quarter is about $100 billion, and it's not really going anywhere because interest rates are still zero. So they're paying rates on the existing debt, which weren't zero at the time that they were issued. But debt going forward, especially short-term debt, is zero interest. So that is not being added to the accrued interest expense here. And then this is when they raised interest rates from 2016 to 2019. Then we hit the apocalypse here, and bam, we're back to the lockdown era, the COVID era. And from here, we are starting to see a vertical move in the amount of interest being paid per quarter, and it's only going to get worse, and I will show you exactly why. Let's go to the next thingy.
Next.
Chicken necks.
This, ladies and gentlemen, is the amount of outstanding debt in each category. The short-term rates from 1 month to 1 year is this category here in the bills, this column. And we see here the number is outstanding, the amount of debt with maximum 1 year maturity is 3.938.9 trillion. Let's just call it an even 4 trillion. It's probably a little bit higher now. And where were we back in 2008 or 2006, let's say 2006, right, when the 6-month yield was around where it is now? I showed you that chart before, 5.32%. There were about $944 billion outstanding in bills. Now, if we go back to 2023, we're at about 4 times that now. And that's how much you're paying on the short-term debt. All of this has to be paid back in a month at the interest rate and being renewed. This is not like you can lock in a low interest rate, let's say, because you're still paying 0% on the 10-year and 20-year treasuries that were issued 10 years ago. This is interest that you're paying now, which is why the interest expense is skyrocketing. But why does this matter? Well, given that Powell, the great sage who is in charge of the Federal Reserve System, has said yesterday, which caused a tank in the gold and silver markets, that he would raise rates probably even higher, even faster, because the consumer price inflation numbers are not coming down as fast as he would have liked, that means the interest on the national debt is going to head even more vertical in the months ahead. And given that we have a debt ceiling debacle going on, which should exhaust itself around September, is the generally accepted time frame here, it's time to look into what is the mechanistic monetary cause of the collapse of a currency. And nobody does that better, explains it better in ways that are eminently logical and clear and easy to understand as Daniel Oliver of Myrmikan Capital. Let's read one paragraph from his work. He wrote back in 2011. It's this paragraph that is key to understand. He writes, hyperinflations always affect highly indebted countries and always strike suddenly, meaning there is not any time to prepare. Once you see prices really starting to move, it's already too late. You got to prepare when the situation is more frustrating. When gold and silver have down days like yesterday, that is when you have to prepare, when you look stupid for doing it. He continues, the common explanation is that there is a psychological moment when holders of currencies realize it is worthless and abandon it. But pleading animal spirits, he makes fun of Keynes here using that term animal spirits, is not a satisfactory answer. He's right. You can't just say there is a psychological moment where suddenly everybody realizes, and it's all in their heads, as if they have a prophecy from God all at the same time. They don't. That's not what's happening. So what leads to that psychological moment? Not to say the psychological moment doesn't happen, but something else causes it. It's not just a spiritual change of heart. So he says, a better theory is that a society-wide short squeeze can elevate a currency's value for a period of time as long as debts are near universal and serviced. It is the fact that everyone's in debt and needs dollars all at the same time that keeps the dollar elevated, because there's a demand for those dollars to service existing debt, and as long as debt can be serviced, the dollar does survive. But, he says, once a critical mass of borrowers actually defaults, demand dissipates, and the currency plunges to seek its economic value as determined by the asset side of the central bank balance sheet. Well, one thing about this sentence, he continues to say here, but I'm going to explain it first, that, yeah, you could have defaults that will not affect the value of the currency, or might even make the currency more valuable, as we saw in 2008. We saw a lot of defaults that made the dollar even more valuable. Why is that? He gets to that in the next sentence. He says, private defaults merely rearrange which parties hold the currency. It doesn't change the monetary situation, because if one party in the private sector defaults to another party holding that company or that entity's debt, you just have a different balance of who owns what assets. Monetarily, nothing changes. He continues, it is rather defaults by assets held by the central bank, or alternatively the helicopter drop that break the short squeeze. And since central banks hold mainly government bonds, there is no collateral to be had. The asset side of the balance sheet is left barren and the currency worthless. So when assets held by the central bank, when those default, that's when the currency starts a free fall, and there isn't any time to buy gold and silver at that point. You can't wait for bonds to start defaulting, for T-bills to start defaulting in order to buy your gold and silver. You got to buy it when it's cheaper and when it's out of favor. Conclusion is we are seeing the vice grip close in on the Fed. The higher consumer prices go, the higher Powell has to keep raising rates. And the higher he raises rates, the higher the interest is paid on the national debt. And the higher the interest that is paid on national debt, with a debt ceiling debacle going on until September, those interests have to be paid. Those interest payments must be made, or the entire system comes apart very suddenly. And even if the debt ceiling debacle is resolved, which I expect it will be, the inflation issue, the consumer prices issue, is not going to be resolved, as we see more and more money plowing itself into basic necessities. Food prices keep rising no matter what is happening in the stock market, which means that the Fed will have to continue to raise rates until either the financial system buckles, which will lead to the final pivot, which will lead to gold and silver making a moonshot, or the Fed doesn't pivot, the financial system wrecks itself, bonds default because there aren't enough dollars as Powell keeps interest rates high, and bonds default, leading to Daniel Oliver's scenario where assets held by the central bank default and the currency finds its economic value of zero as the central bank's balance sheet is left barren with no value in it other than the gold that remains there.